Hey everyone, welcome back to my channel once again. This is your friend Abhishek, but not a financial advisor, and here I am once again bringing up another really informative video for you guys on top 3 stocks to buy in October. And based on the current macroeconomic situation, we will discuss these stocks in detail. So without further ado, let's get right into it. Okay guys, so first thing first, let's talk about the elephant in the room, which is China. Yes, we are going to talk about China's economy because this is going to affect all the asset classes together, not just stock market, not just crypto, not just commodities, everything. And why? Well, we'll get on to that in a moment. So what is happening with China's economy? Well, China has finally introduced a massive stimulus package. Yes, so China's government has finally pulled that trigger to inject massive liquidity back into the economy, back into the system. And not just that, guys. China's government has also introduced a massive $300 billion worth package for the companies, for the businesses in China to buy back their own shares. Yes, and that effect we can already see in the Chinese stock market exchange, the massive rally which is happening in all the Chinese stocks. Now, like I said, China's economy indirectly affects other asset classes as well. And we can see a similar effect in the crypto world as well. The crypto is moving upward. Why? Well, when a government steps in to save an economy, a particular economy, the fiat value of that currency drops, which means that the money, the investors then move to somewhere else where the asset class has a limited supply, which is none other than, Bitcoin. So Bitcoin has a limited supply. And then as we can see, a similar effect is also happening on the commodities as well. So the commodities prices are fluctuating as well. Of course, Middle East is playing a massive role in this case right now as well. But China's economy also plays a massive role in this. So now why I mention this is because this creates opportunity for us. So actually this is a good time to take advantage of all the asset classes, because it's important to also diversify investments to hedge one asset class against another asset class, right? And since we are talking about diversification, that brings me to today's sponsors of this video, which is NAGA. So whether it's commodities, stocks or crypto, are you guys ready to take your trading experience to the next level and take an advantage of the current macroeconomic situation? And it doesn't matter whether you're a beginner or an advanced trader, NAGA has everything you need to succeed with over 4,000 plus assets at your fingertips. And NAGA offers professional tools as well, designed to give you a competitive edge. You can trade, invest, or even copy the moves of expert traders. And speaking of copying, one of the standout features of NAGA is auto copying. So imagine being able to mirror the strategies of the top traders and benefit from the wisdom of the entire NAGA community. And actually it's an innovative way to make the most of the market trends without having to constantly watch the market yourself. And NAGA's platform, it's not just about trading, it's actually about building a community. So you can connect with traders, share ideas, insights, and grow your network. Whether you're strategizing based on economic events or simply looking for the most trending assets, NAGA just simply makes it easy. And with their user-friendly mobile apps available on iOS and Android and their powerful web platform, you can actually manage all your trades anytime, anywhere. NAGA truly offers what a trader needs, everything at one place. And I have a very good news for you guys. NAGA right now has a promotion, a limited promotion, yes. So open up your account, do your KYC and deposit $100. Yes, just $100 and get a free promotion worth up to $125. So hurry up, the promotion is only valid until 27th of October. And follow the link in the description and join. So why to wait? Join the growing trading community at NAGA and let NAGA be your trusted trading partner. So like I said, you can start right now today by following the link in the description. So sign up right now to start trading smarter with NAGA. So now let's talk about our top 3 growth stocks to buy in October 2024. And the first one might be a surprise for you because not many YouTubers, or not at all anyone I guess, is covering this particular company, which is in my opinion way undervalued. So the name of the company is Artcore. And since you guys might not have heard about it, let me just quickly give you an introduction about this company, what this company actually does. So Artcore engages in the manufacture of electrical raceway products. The company is headquartered in Harway Illinois and currently employs 5,600 full-time employees. The company went IPO in 2016. The firm's segments include electrical and safety infrastructure. This is important. The electrical segment manufactures products used in the construction of electrical power systems, including conduit, cable installation accessories, and serves contractors in partnership with electrical wholesale channel. The safety and the infrastructure segment designs and manufactures solutions including metal framing, mechanical pipe, perimeter security, and cable management for the protection of infrastructure. These solutions are marketed to contractors, original equipment manufacturers, and end users. So its products and services include toggle drop-down, conduit, traffic products, and cable tray systems. The company manufactures products in approximately 49 facilities, operates a total of 7.5 million square feet of manufacturing distribution. Okay, so IPO date, and as you can see, now let's talk about some of the basic things of this company, which is some key data and metrics. Okay, so the market cap of this company is just $2.96 billion. Yes. Okay, industry, of course, electrical equipments, and the price to earnings ratio is sitting at 4.4 only. And apart from that, this is a dividend yielding company. So the current dividend yield is at 1.54%, which is not that high, but that comes with an added benefit. The price to free cash flow is sitting at just 7. Yes, and the free cash flow yield is at 13.27%, guys. This means the company is returning a 13% yield to its investors on its free cash flow, and this is huge. Price to sales is under 1. So this, in my opinion, just looking at these key metrics, is way undervalued. But let's go on to further evaluation. But let's dig a bit deeper on the financials and the valuation model. Okay, but let's move one step ahead. I will not dig too much in deep into this particular company because we have to cover 3 companies, but still you will get a basic idea of how this company, in my opinion, is way undervalued. Okay, so now we have a general idea by looking into the key data and metrics. Now let's move on to the financials of the company. So for the DCF model, I will use cash flow as my metric because cash flow, in my opinion, is the only metric which cannot be manipulated. So let's go on to the cash flow of the company. But just for your sake, to see how the company is growing, we can see that since the IPO date, the company's revenue was increasing massively. In 2022, they gained a massive market share and generated an all-time high revenue, and in 2023 they fell a bit lower, so the difference is not that much, so $3.9 billion to $3.52 billion, and this is what we can see right here. But in the trailing 12-month period, if we can see that the revenue is really high. But this is the yearly. But if we jump onto the trailing 12-month period, we can see that they generated again an all-time high revenue of $4 billion. This means they are back on track. And we can also see that from the insights. So we can see right here in the growth, the revenue is increasing at 10.99%. So this is quite good. Okay, so this means a revenue increase of approximately 10 to 11%. So now let's jump on to the cash flow statement. Let's go on to the free cash flow right here, and we will see on the yearly basis. And here we can see the pattern of the cash flow. So in 2021, in 2022 again, like we saw in the income statement as well, they generated a massive all-time high, record high cash flow. And now for our DCF, let's go on to the metrics because we will take cash flow margin as our metric. And here, if we go on to the yearly basis, we can see they are generating a value of 17 to 18%. As we can see, average of 17% in the last 3 years. Okay, so this is what you have to remember. So an average of 17% we will take into the consideration for free cash flow margin. Okay, so like I showed you guys, if we go on to the cash flow, we can see that they are generating positive cash flow and the cash flow has been trending upwards. This is what I wanted to show you guys because this is one of the metrics which I really believe in, and this is what we will use in our DCF model. So cash flow margin. And now let's go on to the freeform tool, and here we can see Artcore. So an average price to free cash flow for Artcore has been 9, and now it's sitting at 7.6. Not that cheap, yes, but still under the average value. Okay, and the lowest it has been in 2020, which was 3.9. and the median has been 8.7. So remember that average is 9. Okay, now it's sitting at 7. Okay, so please remember that. And now let's jump on to our DCF model. So I'm considering here free cash flow for the next 5 years. Metric growth rate, I'm taking only 12%. okay, we saw a metric growth rate of an average of 16 to 17%, but we are taking 12% right now. Shares outstanding, they have been buying back shares, and the shares outstanding has been reducing by minus 5%, but again, I'm taking only minus 3% into consideration for a conservative approach. Dividend growth rate, 2% I'm taking into consideration. And price ratio, like you saw, the average was 9 for price to free cash flow, but I'm taking 6, and it's sitting at 7 right now. Okay, but I'm taking 6 as a price ratio because I assume that when their cash flow becomes higher and higher, the price ratios will shrink. Okay, and when the business get more mature, the price ratios usually shrink. So let's take 6 into consideration, and here we can see that the fair value is at 6% above the current trading price, and the future value could be around $134 with a compound annual growth rate of 11.3%, which beats the S&P 500. And now let's have a look what it has to do to achieve this stock price, which is to generate a free cash flow of $690 million. Now, is that achievable? I think so, and this is what the management also believes in. So let me just show you what the management of Hardcore's said. So Hardcore's management has consistently provided realistic outlooks, and their ability to manage costs and exceed expectations is a positive indicator for future performance. The company's valuation suggests significant upside potential with a projected revenue of $4.3 billion and $650 million in free cash flow by 2029. And we are almost near that $650 million. And here we are taking conservative price ratios as well. Okay, and here we are taking 6 as a price ratio, but let's say if we take 7 as our price ratio, which it actually is trading at, and that means a compound annual growth rate of 14% and fair value 23% below what it's trading right now. And this is why I wanted to mention this as one of the stocks which I am definitely buying in October, and also have suggested to my patrons as well. And of course, if you guys would like to see some more analysis on our stocks and what we are doing on day-to-day basis, then feel free to join our Patreons community. The link will be in the description down below. Okay, now let's jump on to our second stock to buy in October 2024. Top growth stock to buy in October 2024. Okay guys, so here's the second stock which I think is undervalued in October 2024, and that is Celsius Holdings. So, and if we look at some of the key data metrics, we can see the price ratio sitting at 29, which is not that cheap, but don't just judge the business by just one metric or one ratio. And we can see the market cap is sitting at $7 billion and the earnings per share is at 1. Okay, so here we have some other data and metrics. We can see that the price to free cash flow for the trailing 12-month period is at 28, which is quite expensive in my opinion, but what we can see is that free cash flow yield is sitting at 3.49%. So this is also not that high. But again, so these key data metrics give us a general idea of how expensive the stock might be. But let's move one step ahead to see how it could be in compared to its competitors, or the future might look like for Celsius. So the competitor, as we know, for Celsius, the biggest competitor is Monster, and we will get onto that in a moment as well when we are talking about the DCF. Okay, so let's move on to the financials first, and let's see how is the income statement looking for Celsius. And it looks quite good because their revenue is increasing at a massive rate, and we can see right here that their revenue has been increasing by 50% year over year, and gross profit is also increased by 70%, and the most important thing, operating income has been increasing by 500%. Okay, this cannot be consistent, but we can see that the business is generating a huge amount of profit, and that is quite good. This also means they can also, eventually pay back in the form of buying back shares or whatever to the shareholders if they keep on generating a massive profit. But now let's move on to the cash flow, because that is quite important. And here we can see quite an important detail, that is it is only recently that Celsius has become profitable. And that's why I mentioned, looking just into those ratios, price to earnings at 28 or 29, yeah, and the free cash flow yield just sitting at 3.8%, which is actually quite high for such a business which just became profitable. This is actually cheap, because when such businesses are becoming more profitable, the investors are more excited because now their growth phase has just begun. And that's why those price ratios actually still looks to me quite cheap, because when such businesses enter such profitable phase, the price ratios expand. Really, investors are super excited and they're ready to pay a premium for such businesses. But in my opinion, because of the current macroeconomic situation, this is not happening or hasn't happened yet, but eventually will happen. So the metrics will expand and the price ratios will expand as well. Okay, so since the explanation for the free cash flow is done, let's take free cash flow margin into consideration, because this is what we will use for a DCF model. And as we can see, it just became profitable. So we can see that in the first year they made a 15% free cash flow margin, and the second year 9%. It dropped. The change was 38%. But this is again because of the current macroeconomic situation. So let's look into the trailing 12-month period. And in the trailing 12-month period, we can see that 19% in the third quarter, 19%, their free cash flow margin was 19% in the first quarter, and then 16% in the second quarter. So I think as soon as the macroeconomic situation is, let's say, more in favor of the cyclical stocks or more in favor of the strong economies, this will become much better. But still, okay, let's take a conservative approach and let's just take 15% as our metric growth rate, not 19%, not 20%, 15. And we are calculating it for the next 5 years, okay? So shares outstanding are increasing by 6%, which is quite not so good. Dilution is never good, yeah. But let's assume 6%, because I think that they will start buying back after, being profitable for a few years, and after acquiring a consistent market share, they will keep this number really low, or in fact buy back. Okay, the price ratio, now why 35? Let me just give you guys an idea. So the average for Celsius had been 114, and this is what I just mentioned. So these ratios actually will expand because the business just became profitable and investors gets excited, and that's why 35 is actually really cheap for such a growth business. But still, let's keep it as 35, because after 2 or 3 years staying profitable, the ratios will shrink a bit, not this much. I still think it will be about 50 or 60, but let's assume 35, okay, to be more on the conservative side. And that gives us a price target of $53, which is 80% above our current price, and with a compound annual growth rate of 12%, okay, with a discount rate of 10%, because this is the minimum I expect from individual stocks at least, okay. Otherwise I would simply go and invest into S&P 500 or any other index, NASDAQ 1000, or for those who are living in Germany, DAX index. And now let's see what it has to do to achieve this stock price. That means it has to generate a free cash flow of $494 million. Now, is that achievable? Yes, I think so. And why? Well, let me show you guys. So here we are. So we can see this is from the Celsius management report. So we can see right here, Celsius has approximately 12% of energy drink retail sales when including online channels, with Monster Beverage, Red Bull at close to 30% and 40%. Okay, these are the competitors for Celsius. So that means there's still a lot of room to push for consumers to switch energy drink brands. And if it can hit 15% or even 20% market share within the next 3 years, that would be a lot of revenue growth for the company. So then let's assume if Celsius is able to acquire 15 to 20% market share, that would mean they could generate a revenue of around $3 billion or $3.5 billion in the next 5 years. And with 15 to 16% cash flow margin, they can definitely generate $490 million or even higher. So that is why I think that this is easily achievable. But now let's play a bit with the numbers. Let's say the price ratio is at 50, which I expect it to be, and that would mean a future stock price of $76, which is 150% above the current stock price, okay? And a compound annual growth rate of 20%, which is amazing in my opinion. So this is all with Celsius, guys. And now finally our third growth stock for the month of October 2024, which is Lululemon. Yes, guys, I have made a video already on Lululemon, but let me just show you guys why I still think Lululemon is an undervalued stock for the whole year 2024. So we can see right here, price to earnings ratio is sitting at 21, forward price to earnings ratio is sitting just at 17, and the price to free cash flow is sitting at 20.35. So if we just go on to see the average price to free cash flow of Lululemon, we will understand that how undervalued this particular company is right now. So let's have a look at the price to free cash flow metric for Lululemon, and the average had been 71 and the low 16.4, which was this year itself, and this is when I actually covered this stock in my previous video. And the median has been 49 and now it's sitting at 19.75, and this is the reason why I am considering Lululemon as a growth stock and an undervalued stock for the month of October 2024. So that's it, guys. With that being said, we are finally done with our 3 growth stocks for the month of October 2024, and this is what I wanted to cover in this video. And please don't forget about the promotion of NAGA, which is only limited for you guys until 27th October, only if you use my referral link in the description below and in the pinned comment as well. And with that being said, guys, we are done for today. And if you guys would like to see a detailed video on Lululemon, because we just covered here a few minutes of Lululemon and my personal opinion with only one metric into consideration, if you guys would like to see the detailed video, you can have a look right here and you will see me right there in this video. So until then, stay safe, stay healthy, and ciao.